Investing your money in the investment market can yield a fantastic return, which is why so many people take this path to achieve their long-term financial objectives. However, investing may be frightening and intimidating, especially for first-time investors. Fortunately, there are various solutions regarding the best investments for beginners that meet a variety of goals, budgets, and levels of comfort. This guide will cover the most common possibilities, but a financial advisor may assist you in identifying your best selections and providing guidance when you make your first investments. High Yield Savings Account (HYSA). If you want to make more money but are afraid to invest, consider opening a high yield savings account. An HYSA has a substantially greater APY than a regular savings account, allowing you to optimize your return on investment without taking any risks. Short-term certificates of deposit (CD). A certificate of deposit is a type of savings account that has a higher annual percentage yield APY than a standard savings account. A CD is a deposit of a large sum of money for a set period of time. You cannot access the funds without paying a penalty during the account period. When the CD matures, you can withdraw the money or deposit them into a new one. CD periods range from 6 months to 5 years. The APY on longer-term CDs is typically higher. However, there are several short-term, no-penalty CDs available, such as CITS 11-month no-penalty CD. A money market account. A money market account, which is a form of savings account with a greater APY than a standard one, is another low-risk choice. MMAs have additional perks, such as the ability to use a debit card or write checks, allowing you to access the money when needed. U.S. Bank provides a competitive money market account option that enables you simple access to your funds via a debit card or check writing capabilities while generating a greater annual percentage yield APY than a standard savings account for low-risk saving. Mutual funds. A mutual fund is an organization that pools money from a number of individuals with similar investing goals and invests it in stocks, bonds, money market instruments, and/or other securities. This allows you to diversify your investments rather than putting all of your eggs in one basket. After deducting applicable expenses and taxes, the income profits generated by this collective investment are dispersed proportionally among the investors by determining a scheme's net asset value or NAV. Index funds. An index fund is a mutual fund or exchange-traded fund that tries to replicate the performance of a market index. Index funds may strive to track market indexes such as the S&P Wink with tongue sticking out 500 index, the Russell 2000 index, and the Wilshire 5000 total market index. A market index monitors the performance of a basket of securities such as stocks or bonds that are intended to reflect a sector of a stock market or an economy. Stocks. A stock is a type of security that represents a portion of a company's ownership. When you acquire stock in a firm, you are purchasing a small portion of that company known as a share. Investors buy stocks in firms they believe will increase in value. If this occurs, the value of the company's stock rises as well. After then, the stock can be sold for a profit. A shareholder is someone who owns stock in a company and shares in the firm's profits. 401k. Many firms in the United States include a 401k retirement plan as part of their benefits package. With a 401k, a percentage of your earnings is set aside as a contribution, which can be pre-tax or post-tax depending on the kind of plan. Traditional 401k contributions are pre-tax, which reduces your taxable income but means you'll have to pay taxes when you withdraw assets in retirement. Contributions to a Roth 401k are taxed upfront, so you won't incur taxes on your money when you retire.